Hey guys, very good evening, guys. Today I'm going to be highlighting a very important source of information. And I think that the time has come when we need to start discussing about this information in a relatively nicest way. Before I continue, this is Rahul Magan from Treasury Consulting as a group CEO and venture capitalist. Treasury Consulting is a multinational group. We operate in Singapore, India, Hong Kong, and God willing, as soon as coronavirus is over, we would definitely start our journey in London and New York. We are waiting for the things to start and to things to get better soon, and hopefully we will start soon. Today, I wanted to cover a very important discussion that has somehow started in the public domain across the globe, including India. And I'm really happy that that discussion has started. Generally speaking, when we invest in any stock or index, our beloved media always talked about P to E ratio, price to earning ratio. They hardly talk about PEG ratio, price to earning growth ratio. Anyways, we are not going to discuss this again because we have already covered in our video, so no point of discussing again. But as a hedge fund desk, we believe in PG ratio. We don't believe in PE ratio because PE ratio can easily be manipulated. It can easily be manipulated. Just like if any corporate is just moving up in terms of market capitalization, that guy, hey guys, that really doesn't mean that that corporate is performing exceptionally well. To be honest, there could be a big possibility that an operator or an operator driven firm is just pushing that stock to go to the higher level and making sure that the market capitalization is like, oops. In the very recent web series on the Sony Live, and whereby Harshad Mehta, I think season 1, the same has been highlighted number of times when the share price was like shoo without any tactful reason. Anyways, even today it is happening. It would continue to happen even after 20 years. So no point talking because no one is really bothered. And retail investors really do not know whether to enter or whether to exit, as simple as that. But one of the nicest discussion that has started in the social media, and I think I should make a video in that regards, which is that should the portfolio we have must should the portfolio have the dividend yield stocks? That's really interesting discussion because there are two important ratios which we have, you know, in fact, four important ratios that we have when it comes to the stock evaluation. Number one is definitely the price to earning ratio as per our loving media. Second is definitely the price to earning growth as per me. Third is definitely the dividend yield. Fourth, U10. Dividend yield is having two parts. One is DPS, dividend per share. Of course, I agree to the fact that if you're having a good money and you're having a good portfolio, then you should have few stocks, those who are regular dividend giving stocks. Example, pandemic officially came in India in March when the lockdown announced by Prime Minister sir. And even today, you know what is happening. Few states are having night curfews, and I was just watching Bloomberg and I got to know that Los Angeles, LA, shortly in US, is heading for yet another lockdown. Maybe New York and other cities of the globe or states of globe heading for another lockdown. We really do not know. Because vaccine and vaccine news are different. That is very important. But we are not getting that point even today. Now, when the lockdown started in India in March, economic activity was like standstill, no action. Everything was closed. Everything was closed. Because of that, GDP contracted by around 24%. And what had happened in September, we understand that as well. But in September, one good thing also happened that we really need to appreciate and praise. And I think without praising that thing, the video cannot be concluded, is that Indian companies, few, recovered very fast. While the retail companies, small companies, MSMEs, they might not be able to recover the way we envisaged, but the big corporates recovered very fast compared to the mess that started in 2020. And many good corporates paid good dividend also. Like Treasury Consulting also invest in the market. We also got good dividend. Now the question is that before you select a stock, of course, that doesn't mean that if I'm having 100 rupees of investment, I will invest all 100 rupees in a dividend paying stock, because there is an irony with the dividend paying stocks. And that irony is not in India, it is across the globe. Stocks who offer capital appreciation give you literally no dividend. The stocks which give you dividend will not give you the capital appreciation just like the other category gives. So example, the stock who give you capital appreciation, example 100 rupees, 120, 140, 150, 180, 200, 220, 240, 260, 300. I bought at 100, now it is 300, which is 3 times of my portfolio is 3 times. They will not give you the dividend which you are thinking, guys. They will give you 20 cents, 30 cents, 50 cents, maximum 1 rupee. Thank you. Please don't expect much. Because the company themselves understand very well that, hey guys, look at our share price. It was 100 rupees. Now it is 300. Your portfolio is 3 times. Still you are expecting dividend from me. Come on. Okay, I earned profit, but let me have my dividend in my balance sheet and I'll invest in, in my projects, in my R&D and so on and so forth. So please don't expect that. Other thing is the stock who really don't offer much capital appreciation. Example, 100, 110, 120, after 6 months, 140. They will give you even 5 rupees as dividend. Why? They want people to buy this stock because the capital appreciation is very poor. And unfortunately, many of these stocks are small caps. That is also a hard reality, that many of such stocks are really small caps. So what should be the strategy of an investor? What should an investor do? Investors should have at least 10% of the portfolio in a dividend paying stock, but dividend paying stock should be rightly evaluated historically. Example, there is a ratio called DPS. DPS is not Delhi Public School. It is not Dehradun Public School. DPS means dividend per stock. Now, we need to check historically that how much dividend has been given. Example, I just take hypothetical example, Infosys. If you check on Infosys, you get to know what is DPS. TCS, what is DPS. Wipro, what is DPS. SCL, what is DPS. Zensar, what is DPS. And all these kind of, we get to the DPS. And it is said number of times that the people, those who are holding the retirement money, example, the people who are retired, they have no money, they are having limited money, they should have a considerable investment in dividend yield stock. No. This is a myth. No, guys, don't do this. 2020 tested this proverb very hard. Before 2020, people used to believe that the retirement people should have excellent money in the guilds. Now, guilds means, the government securities. Let me show to you something which is very important. Hold on, guys. Oops, I think yes. Should a retiree invest in guild funds? Before 2020, many people used to believe that retirement fund, that retirees should be investing in guild funds. By the way, what is guild funds? Guild funds are those funds, those who invest in the government securities, maybe STS, state government loans, and so on and so forth. But guys, 2020 tested this equation really very hard because RBI cut the repo rate like oops, and even today there is no guarantee that there is no rate cut which is in the line. We really understand that. To stimulate the economy, if there is a requirement of rate cut, RBI will definitely go ahead. I'm 200% sure. And there was another thing which was there before 2020 is that retirees or retirement funds should have very good exposure in dividend yield stock. That also tested very hard in 2020. How? Because of pandemic, many companies who used to declare historically used to declare good dividends, they are like, oops. And we cannot blame these companies, by the way. We cannot blame these companies because these companies really did well historically. But every pandemic or every testing times bring us closer to the change. And change is the mandatory thing we have in the life. That's really very, very important. Henceforth, the two proverbs that retiree or retirement people should invest it in guilds, or retirement people should have good exposure to dividend yielding stock, I think this no more hold true. According to me, the maximum a portfolio can have when it comes to dividend yield stock is around 10%, not more. Because remember, guys, those who offer good dividend, then their shares do not offer good capital appreciation. Of course, exceptions are there. AB de Villiers, Mr. 360-degree. You tell him where to play a shot, he will play. He is a right-handed batsman, but don't worry. You tell him where to play as far as the left-hand batsman is concerned, he will play. Don't worry. Rest assured. And even you ask the captain of the fielding team to do every mathematics, but even after this, he will play. So exceptions are definitely there. So guys, now market is little bit recovering. I at least say that it is little bit recovering. There are people those who are saying that Sensex is around 44,000, while Nifty is very or inch up to 13,000 and so on and so forth. But I think it is recovering because still many stocks are below intrinsic value. And I am a big supporter of intrinsic value, irrespective of the fact that many people on the YouTube do not regard that concept. But this is their problem. I always believe that one should trade on intrinsic value rather than on the hype. Oh, it is going up. Let it be. Is it closer to intrinsic value? Yes. How much? If no, then why are we chasing? Forget. Simple. So we need to understand that even though Sensex is 44, Nifty is around 13,000, guys. After vaccine, a boom is there across the globe. I'm telling you. The day first vaccine will come on the table. Example, somebody will come and say, this is vaccine. This regulator approved this. This is on the table. Markets are like, just like this. Question is, this thing really have some time. Even though I appreciate too much news is coming in the public domain. Is it a time when we do some research and get to know who is better dividend yielding stock? Of course, element of credit risk is always there. Until otherwise you buy a dividend yielding stock of a government company where government is a kind of sovereign guarantor. And I think I really, although I rarely thanks to the media in India, but this time I really thanks to the media in India for raising this concern. And that is the reason I have shot this video, that the time has come when we need to think that, are we chasing capital appreciation? Number one. Are we chasing dividend? Number two. Or are we chasing both? Number three. But guys, before I conclude, remember this very carefully. Huge research is required. It's not easy. And don't expect it to be easy. Number one. Number two. Historical performance is always historical performance. Any country, any cricketer scored century in the last match doesn't mean he will score century again in this match. Number three. Sometimes market dynamics change in a span of 1 hour, and you see that dividend yielding stocks start taking capital appreciation or vice versa. A capital appreciation stock came in public domain and say, I'm going to offer you dividend. So these tactful things are always there. We need to understand that very carefully and keep them in our mind. It's very important. But I can say, as we are closer to the vaccine, at least we can say, which we were not been able to few months ago, then I think the time has come for the dividend yield stocks to fire. But once again, out of thousands of listed stock, finding dividend yield stock is really tough. But that is what the life of a portfolio manager is. Before I conclude, that is what the EMCs wanted to say, the dividend yield opportunities fund? I really don't think so. This is Rahul from Treasury Consulting. You know our WhatsApp 9818485155. Treasury Consulting continue to educate people. Treasury Consulting continue to raise the points which unfortunately even not raised by regulator. Treasury Consulting is continue to elaborate the points which are outrightly ignored by the media across the globe. And Treasury Consulting believes in the fact that thinking beyond convention is something that very much important to everybody. And I think that is the reason why an individual, Steve Jobs, who was not having limited money in the pocket in somewhere 1975-76, end up being as an entrepreneur or founder of Apple, because he always thought from a different angle. And that is the reason why people said, I repeat for you, Apple has lost a visionary and a creative genius, and the world has lost an amazing human being. All of those who have been fortunate enough to know and work with Steve have lost a dear friend and inspiring mentor. I completely agree. Steve leaves behind a company that he could have built, and his spirits will forever be the foundation of Apple. Steve Jobs. And Treasury Consulting really dare to think out of convention. Because remember, hype always ends up smallest lives, while the fundamentals, maybe they struggle a bit initially, I agree, but they end up being the longest and the highest life. Do we understand the difference between longest and highest life? That's very important. Life could be longest, it could be highest. Choice is yours. Or life could be hype. Choice is yours, guys. This is Rahul from Treasury Consulting. You know our WhatsApp, and have a great time, guys. Thank you.